Joining us right now to talk through what she's seeing in the markets is Kathryn Kaminski. She is Chief Research Strategist and Portfolio Manager at AlphaSimplex. And Kathryn, I know you've made the point that bad news lately has been good news for equities. What do you think of the data that we just got? The PCE coming in line with expectations, but the year-over-year number a little bit stronger than we'd seen last month.
Well, the truth is today is no news is good news, even though we've had some bad news earlier this week. And so this is really a respite trade that we're dealing with right now. We're not seeing upside risks. So the market is excited that we're not going to have hikes soon.
What if the Fed actually does raise rates?
Well, that would definitely be a surprise. But I do think they have projected they're looking for upside risk. If we see some numbers move, I think you should start looking at the energy moves right now, things like that might actually cause us to see some surprises. Those are the things that are going to cause us to actually have a hike, or if we see stronger labor data later this week, that's going to mix the picture. But right now, we're really seeing a situation where we're going to be higher for longer in terms of yields. And that's probably something that people need to think about as opposed to hikes as the real issue.
Yeah, you've been bearish on bonds. You've been short bonds, actually, for most of 2022 and 2023. Trade's gotten a little more complicated very recently. What do you think?
Yes. I mean, being short bonds was the trade of the year in 2022. And let me just tell you, it wasn't fun this week. And so being short bonds means, in essence, that we think that bonds are not really a good place to be when you have higher inflation. And you need to really focus on the shorter end of the curve until we start to see the yield curve stabilize. So those of us in the futures markets, we've really been seeing short pressure on the 10-year, the 30-year. And this is really a trade about how long will rates be higher. And we think they'll be higher for longer than people think. And that means that that particular short trade still might have some room in it until the end of the year.
You think yields will be higher for longer than people think because inflation will be hotter, or because the Fed's going to be pretty persistent about trying to get it down to 2% and not rest at 2.5% or 3%?
We think that inflation will take longer to come down because it doesn't come down as quickly as people would like. So it was easy to get it from peak, but it's harder to get to a level that's at target. And let's just remember, even though we have cooler data, we haven't gotten to target. And it was reiterated last week that we are going for target, unless, of course, the Fed releases its target and says we're not going to pay attention to that, but that hasn't been the case. So I think the real point is inflation is higher, and we're going to stay at higher rates until it's better.
But you're walking a pretty fine line. You think inflation is higher, but the Fed's not going to do anything other than just keep rates where they are. So is there a misstep that could mean that, okay, if your view on bonds is right, that your view on the market has to come down? And I'm sorry, we've only got about 30 seconds.
Yeah, well, the point is it's about the curve shape, right? So the curve is still inverted. That's what I'm talking about. You look at those long-term bonds, they're definitely underpriced relative to shorter-term bonds. We think that has to flatten unless, of course, we see cuts in the near term. So there's still a big differential between those two. And in the next few months, you're going to have to see that tighten up.